One, it's important to recognize that management would love that outcome. If they could have one meeting and then sell $1 billion worth of stock, that would be a great outcome for them. Unfortunately, it doesn't quite work that way. And you really have to focus on the large investors. The large investors insist on one-on-one meetings. They refuse even to go to a group lunch meeting. And the reason they do that is in their questions, it will reveal either their interest, their concern, their excitement about the prospective IPO. So they want to keep that quiet. So you'll end up with the roadshows primarily because investors are demanding that kind of time frame.
Bob, I think the Lyft IPO highlighted this because you had a scenario in which people who got the stock at $72 and could sell it on the open at 87 were obviously pretty satisfied with that. But if your first chance was to buy it at 87 and it's since, gone down to 72, it doesn't feel so great. And maybe the public is wondering, was there some information that the insiders had access to, and why couldn't we have seen these documents?
No, I don't think it's that would be the question. The question is, why does not retail get more of an allocation? They typically get a certain amount of allocation. The IPO certainly can be higher. And when you have a publicly known stock such as Lyft, you can certainly see you can guess what would be the ceiling there. But with the retail investors, is a common perception or misperception that they tend not to be long-term holders. They'll tend to be flippers on the stock. So the company, again, they're trying to place $1 billion worth of stock. They like to do it as quickly, as efficiently as possible.
Right.
Second order desire is to have a group of investors which will hold for a longer period of time.
I just
Rightly
wonder,
or wrongly, retail investors do not have that brand image right now.
It's odd to me. And of course, they shouldn't ever be required. Or maybe you could. Maybe they could say, look, you can participate if you hold it for a year. But if I'm the SEC and I know that there are people who have access to an IPO and flip it on the open, that would seem like a bigger potential black eye for the marketplace than it would be to give retail a bigger share of that. I also wonder, with the move towards direct listings that we've seen from, I believe it was Spotify and maybe now a few others, is there something in there where even the companies who are trying to do a direct listing, not even raise any additional capital, but some of these maverick type of Silicon Valley companies might say, hey, sure, we'd like to do something more directly offering this to the public. Again, is there any reason in the public interest why there shouldn't be more access to this information and to these IPOs?
Well, I would say direct listing probably less likely in that they're not trying to raise funds, so retail investors like anybody else can come in on the secondary market. You could argue that's fair and democratic because institutional retail don't have access to capital raising, but they can trade on the secondary market. So I don't think that would be the point of change in practice. I think when you think about stocks, as I said, that a big brand retail image, right, that's the place where the underwriters can say, let me give retail a greater share of the pie.
Yeah.
The important point you have to get past is the concept that retail investors will churn quicker than institutional investors. I've seen different studies that show different results on that, but clearly the branding is that retail will tend to flip more frequently, and that's why you don't give them a larger allocation.